What happened in Venezuela this weekend and what China did on January 1st are not separate stories. They are the same story, converging at the exact worst place possible, the COMEX silver vaults. And once you see the connection, you'll understand why this move isn't a spike, it's a repricing. January 5th, 2026. Silver opened Monday morning at $75.33 per ounce, up 5.5% in a single trading session. Not a gentle rise, a blast. And if you think this is just another commodity bump you can ignore, you haven't been paying attention to what happened over the weekend while most people were enjoying their holiday hangovers. Because two events converged in less than 72 hours that fundamentally changed the silver market forever. First, the United States military captured Venezuelan President Nicolás Maduro in a pre-dawn raid Saturday morning, triggering what the United Nations is calling a dangerous precedent that threatens global stability. Second, China's new silver export restrictions, announced months ago but taking full effect January 1st, just hit the physical market like a freight train with no brakes. And here's what nobody's telling you. These aren't separate stories. They're connected. And the connection runs straight through the COMEX vaults in New York, where registered silver inventories just dropped 70% since 2020 and are now sitting at levels that some analysts are calling unsustainable. Let me show you exactly what happened, why it matters, and what comes next. Because this isn't about predicting silver's price tomorrow. This is about understanding that the system keeping silver prices suppressed for decades just broke. And when systems break, they don't send you a warning email first. Saturday, January 3rd, 2026. Roughly 2 a.m. local time in Caracas, Venezuela. A series of explosions rocked the capital city. Residents reported low-flying aircraft, rockets hitting civilian neighborhoods, and military installations engulfed in flames. Within hours, President Trump announced on social media that the United States had captured President Nicolás Maduro and his wife, Celia Flores, in what was codenamed Operation Absolute Resolve. Now, whether you think this was justified or illegal doesn't change the market reality. And the market reality is this. Venezuela sits on 303 billion barrels of oil, roughly 1/5 of the world's total reserves. That's not speculation, that's data from the U.S. Energy Information Administration. And when you remove a sitting head of state from a major oil-producing nation through military force, commodity markets react. They always do. But here's where it gets interesting for silver. The operation didn't just create geopolitical uncertainty, it created what traders call a safe haven demand shock. Gold hit new highs. Platinum surged 10% in a single day. And silver, which had already been building pressure from structural supply deficits, exploded upward. Because when global stability looks shaky, when military interventions happen in oil-rich nations, when the UN Security Council schedules emergency meetings, investors don't rush into stocks. They rush into tangible assets that governments can't print more of. And silver, unlike gold, has been undervalued relative to its industrial demand for years. But wait, there's more. And this is where China enters the picture in a way that should make every industrial manufacturer in America deeply nervous. January 1st, 2026. China's Ministry of Commerce implemented new export restrictions on silver that fundamentally changed global supply dynamics overnight. Not a ban. Let's be clear about that. This is a licensing framework that replaces the previous quota system. But the effect is essentially the same because only large state-approved companies can now export silver from China. And here's the number that matters. To qualify for an export license, companies must demonstrate annual production capacity of at least 80 tons of silver and maintain consistent export records from 2022 to 2024. That requirement just eliminated hundreds of smaller and mid-sized exporters who have been critical suppliers to global refineries and manufacturers. China controls between 60% and 70% of the world's refined silver supply. When you ring-fence that much of any commodity behind government licensing, you're not managing trade flows, you're weaponizing supply, and silver isn't just a precious metal anymore. It's a critical industrial material that goes into solar panels, electric vehicles, semiconductors, AI data centers, medical devices, and defense systems. Elon Musk responded to this news over the weekend with a post on X that said, "This is not good. Silver is needed in many industrial processes." That's an understatement. Silver has the highest electrical and thermal conductivity of any metal on Earth. It's irreplaceable in many applications, and the world's largest supplier just told you that domestic priority comes first. Now, let's connect these dots. Venezuela creates geopolitical risk. Geopolitical risk drives safe haven demand. China restricts exports, creating physical supply stress. And where does all this pressure show up first? The COMEX. The COMEX, short for Commodity Exchange Inc., is where silver futures are traded and where physical delivery happens, when buyers want actual metal instead of paper contracts. And right now, the COMEX is experiencing what some analysts are calling a structural breakdown. Registered silver inventories, that's metal available for delivery against futures contracts, have fallen approximately 70% since 2020. In late December 2025, over 60% of registered inventory, roughly 47.6 million ounces, was claimed for delivery in just 4 trading days. 4 days? That's not normal market function. That's a squeeze. And here's the warning sign that should terrify anyone holding paper silver. The market went into deep backwardation. That means spot prices are trading at a premium over futures contracts. In a normal commodity market, futures trade higher than spot because of storage and interest costs. When that flips, when spot is more expensive than futures, it signals immediate physical demand that can't be met. In Shanghai, physical silver is reportedly trading above $80 per ounce. COMEX paper silver was quoting significantly lower. That spread, that divergence between physical and paper, that's the market screaming that something is broken. The CME group, which operates the COMEX, issued advisory 25-393 in late December, raising margin requirements for silver futures to $25,000 per contract to prevent what they called market instability. Translation, they're trying to slow down the delivery demands before the vaults run empty. Now, let me give you some historical context, because this pattern isn't new. In 1980, silver hit $50 per ounce during the Hunt Brothers squeeze before regulators changed the rules to force liquidation. In 2011, silver surged from $8.50 to $50 driven by quantitative easing and European debt crisis before the CME raised margins 5 times in 9 days, triggering forced selling that crashed prices 30% in weeks. Notice the pattern? Every time physical demand threatens the paper market structure, exchanges intervene. They raise margins, they limit positions, they change the rules. Because the futures market only works when most participants settle in cash, not metal. When everyone demands delivery simultaneously, the system breaks. And that's exactly what's happening right now. China's export restrictions removed 60 to 70% of potential supply from the global market. Industrial users in semiconductors, electric vehicles, and solar sectors are bypassing paper markets entirely, buying physical at whatever price they can get, because they're terrified the metal won't be available in 60 days. According to analysis from multiple sources, global silver demand in 2025 reached approximately 1.24 billion ounces, while total supply, including mine production and recycling, was only about 1.01 billion ounces. That's a structural deficit of over 230 million ounces, equivalent to Mexico's entire annual production. Mexico, by the way, is the world's largest silver producer. For 5 consecutive years, demand has exceeded supply. 5 years. That's not a temporary imbalance, that's a secular trend. And the reason prices didn't explode earlier was because above ground stockpiles, inventories sitting in vaults, were being drawn down to fill the gap. But those stockpiles are now depleted. COMEX is at decade lows. London Bullion Market Association vaults are down 40% since 2020. Shanghai inventories are at their lowest level in a decade. Some industrial regions have barely 30 to 45 days of accessible silver reserves at current consumption rates. And here's the part that makes this different from 1980 or 2011. Industrial demand is structural, not speculative. The Hunt brothers were trying to corner the market for profit. That was a bubble. This is different. Solar panel installations doubled in 2024. Every panel needs silver paste. Electric vehicle production is up 40% year over year. Every EV uses twice the silver of a combustion engine. 5G infrastructure build-out is accelerating globally. Every tower needs silver components. This demand isn't going away. It's growing. And the supply to meet it just got choked off by export restrictions from the dominant global supplier. Now, you might be asking, can't miners just produce more silver? Great question. Here's the problem. Unlike gold, which is mined specifically for gold, about 70% of silver production is a byproduct of mining other metals, primarily copper, zinc, and lead. That means silver supply is tied to base metal economics, not silver prices. If copper prices are weak, copper mines don't expand. And if copper mines don't expand, silver production doesn't increase, even if silver prices double. And even when new projects get approved, they take 8 to 12 years to develop from discovery to production. There's no quick fix. The supply deficit is locked in for years. Venezuela's situation adds another layer. While Venezuela isn't a major silver producer, the military operation creates broader commodity market instability. Oil markets are on edge. Sanctions and blockades disrupt trade flows. And when commodity markets get volatile, investors flee to tangible assets. That increases investment demand for silver precisely when industrial demand is already consuming more metal than mines can produce. Let me show you what happened Monday morning when markets opened. Silver blasted through $75, up 5.5% in a single session. Gold hit new records above $4,500 per ounce. Platinum surged. The dollar weakened as geopolitical risk increased. And trading volume in silver futures spiked as industrial buyers competed with investors for limited physical supply. Analysts are projecting that if current trends continue, Silver could challenge $100 per ounce in the near term and potentially reach $150 if physical supply constraints intensify. Those aren't hype targets. Those are based on supply-demand fundamentals and historical precedent for how markets react when physical scarcity meets sustained industrial demand. But here's the uncomfortable truth that most mainstream financial media won't tell you. The paper silver market is built on leverage ratios that only work when physical delivery remains rare. Current estimates put the paper-to-physical ratio at approximately 356 to 1. That means for every ounce of physical silver available, there are 356 ounces of paper claims against it. This works fine when everyone accepts cash settlement. It breaks catastrophically when participants demand metal. And China's export restrictions just made physical silver dramatically harder to obtain, which means more participants will demand delivery from the COMEX because that's one of the few remaining sources of available supply. The CME's margin hike to $25,000 per contract is an attempt to slow this down. Higher margins mean traders need more cash to maintain positions, which forces some to exit, but this is treating the symptom, not the disease. The disease is structural supply, deficit meeting export restrictions, meeting safe haven demand. Now, let's talk about who wins and who loses in this environment. Primary silver producers, companies that actually mine silver, are seeing valuations explode. Cure Mining, one of the largest US-based silver producers, delivered a 229% stock return in 2025 after completing its Rochester mine expansion in Nevada, just as prices surged. But here's the risk. If the COMEX fails to deliver physical metal to a major industrial buyer and declares force majeure, that's a technical default. That would send prices vertical because it would confirm that the paper market can no longer be trusted to provide physical metal. Every industrial user would immediately attempt to secure supply through private contracts at whatever price necessary. On the losing side, anyone holding paper or silver ETFs that aren't fully backed by allocated physical metal. If the underlying metal isn't sitting in a vault with your name on it, you're holding a promise, not silver. And promises become problematic when supply is constrained. Also at risk, industrial manufacturers who relied on just-in-time procurement and didn't lock in long-term supply contracts. Semiconductor fabs, EV manufacturers, solar panel producers, they're all competing for the same shrinking pool of available metal. Whoever pays the highest premium gets supply. Everyone else faces production delays. The geopolitical angle adds complexity. China's export restrictions aren't just about silver. In October 2025, they implemented similar controls on rare earth elements. They're systematically ring-fencing strategic materials, leveraging control over supply chains that Western economies depend on. This is resource nationalism, and it's not limited to China. Chile is nationalizing lithium. Indonesia restricted nickel exports. Countries are waking up to the reality that control over critical materials provides geopolitical leverage in a fragmenting global system. Silver, because it's both a monetary metal and an industrial necessity, sits at the intersection of this trend. And the Venezuela situation demonstrates that when geopolitical tensions rise, demand for tangible assets spikes. Combine resource nationalism with geopolitical instability and structural supply deficits, and you have a perfect storm. The Monday morning blast to $75 isn't the end of this story, it's the beginning. Because the forces driving this move, China's export controls, COMEX inventory depletion, industrial demand growth, safe haven flows from geopolitical risk, none of these are temporary factors. Silver surged 148% in 2025, breaking through multiple historic resistance levels. Analysts who predicted this would calm down in 2026 are being proven wrong in the first week of January. The structural drivers are intensifying, not abating. Here's what to watch going forward. First, COMEX registered inventories. If they continue falling below current levels, the exchange faces a credibility crisis. Any hint that delivery capacity is compromised will trigger another surge as participants rush to secure metal before it is unavailable. Second, industrial supply chain disruptions. If major manufacturers announce production delays due to silver availability, that confirms the physical shortage is impacting real-world operations. That brings more attention, more demand, more pressure. Third, China's actual export volumes. The licensing system just went into effect January 1st. We won't have clear data for weeks on how much this actually restricts outbound flows. But if exports drop 50% or more, the supply deficit becomes catastrophic. Fourth, geopolitical developments. The Venezuela situation is far from resolved. Acting President Delcy Rodriguez is sworn in, but Trump stated the U.S. will run Venezuela until there's a safe transition. UN Security Council emergency sessions are scheduled. Brazil and other regional powers are condemning the intervention. This creates ongoing instability that supports safe haven demand. And finally, watch for policy responses from Western governments. If the US or EU implement strategic stockpiling programs for silver, that's confirmation that governments view this as a national security issue. That would add sovereign demand on top of industrial and investment demand. The bottom line is this: January 5th, 2026 marked a turning point. Silver didn't just rise 5.5% because of technical trading. It rose because two fundamental drivers, export restrictions and geopolitical instability, converged to expose the fragility of a paper market built on assumptions of abundant supply and stable geopolitics. Those assumptions are now being tested. And when you test assumptions under stress, you find out which ones were always false. The assumption that China would always export silver freely was false. The assumption that COMEX inventories could handle sustained delivery demand was false. The assumption that paper contracts are as good as physical metal was false. And the people who understand this early, who recognize that we are not in a normal commodity cycle, but in a structural repricing of a critical material, they're positioning accordingly, not with leverage and speculation, but with understanding of supply constraints, industrial necessity, and the limits of paper markets when physical becomes scarce. This isn't investment advice, this is pattern recognition. And the pattern says that when governments restrict exports of strategic materials, while simultaneously conducting military operations that destabilize major commodity-producing regions, markets react. They reprice risk. They favor tangible over paper. They move fast. Silver at $75 is not expensive if the available supply can't meet industrial demand at $50. Price is just the intersection of supply and demand. When supply shrinks and demand grows, price adjusts. That's not speculation. That's economics. The Monday morning massacre isn't about fear. It's about reality catching up to assumptions. And reality says that silver, which has been undervalued relative to industrial necessity for years, is now being repriced in real time as China tightens exports, COMEX struggles with inventory, and geopolitical instability drives safe haven flows. If you're watching this unfold and wondering whether this is temporary, ask yourself, will China reverse export restrictions? Will industrial demand for solar, EVs, and semiconductors decline? Will geopolitical tensions suddenly disappear? Will COMEX magically refill its vaults overnight? The answer to all of those is no, which means the pressure that drove silver to $75 on Monday morning isn't going away. It's compounding. And when pressure compounds in a market with constrained supply and growing demand, the move higher isn't a spike, it's a repricing. Welcome to 2026. The year silver stopped being just another commodity and became a strategic material that governs everything from energy transitions to technological advancement. The year China demonstrated that export policy is geopolitical leverage. The year the COMEX learned that paper markets only work until everyone wants delivery. And the year that Monday morning massacre became the opening act of something much larger than a 5.5% daily move.